All right. Hey, good morning, good afternoon, good evening, whenever you are watching this replay, realtors. This is Scott Groves with the Scott Groves lending team here at Synergy One Mortgage. And wanted to talk a little bit about the math and the emotion that our clients are going through right now with buying a home, right? And also wanted to give you a few resources that I think are amazing. And the first thing is rates, right? Rates are on everybody's minds. Rates. And I will tell you, and we're going to include this link in this replay. If you're looking to get just kind of a synopsis of the market, there is only one place that I trust. And frankly, it's the only website on the internet that will show you rates because it's a website that sells loan officers a product, and it's called Mortgage News Daily. They are the only website that will show you rates without trying to act as a funnel to buy consumer data or gets consumers to fill things out or lie to consumers about having these rock bottom low interest rates in order to attract leads and then sell those leads. So mortgagenewsdaily.com. And at the top of the banner, you just go to where it says mortgage rates. It's the middle tab in the top banner, and it will give you the most accurate kind of current mortgage rate synopsis of what's going on in the mortgage place. And we'll share this real quick. If you just go to, let's share my screen here. If you just go to Mortgage News Daily home and then go to mortgage rates, go to today's mortgage rates, this will give you a pretty great synopsis depending on your scenario. Are you looking for a 30-year fixed? Are you looking for a jumbo? Are you looking for an FHA or a VA loan? This will give you more or less where the rates are and what the trend line is. Is the trend line like moving positive, negative, or kind of minimal, right? And then it'll give you some articles here. But if you, as a realtor, or if you're looking to send your client somewhere where they're not going to end up applying with 10 different lenders and ruining their credit, or they're not going to have a misrepresentation of the market because these lead aggregation sites are just a way to advertise some rock bottom rate for a client and a scenario that doesn't exist in our marketplace. Remember, Mortgage News Daily sells a product to lenders. So they're not trying to lie about the interest rates by selling something to consumers. So first, when people are talking about rates, or you want to do a quick rate check, or you just kind of want to see a trend line of where the market is, go to mortgagenewsdaily.com / mortgage rates, or just click the middle banner where it says mortgage rates and then look at today's current rate. So that's a resource that I would bookmark. I would save the website on your phone. I would feel comfortable sending that out to clients. Like when I want to check for my own company, or like, oh, are we a little bit above or below par on where we're pricing, right? Because sometimes certain companies will lag a little bit on updating their pricing, or they'll be kind of ahead of the market. I myself go to Mortgage News Daily once or twice a week to just say like, oh yeah, everything's in range. Oh, we're kind of beating the market here. We're kind of beating the competition on where our jumbo loans are priced. Oh, our FHA loans are maybe an eighth higher. I got to talk to our secondary market to figure out what's going on there. So Mortgage News Daily, great piece of like, I don't know, just mindset, peace of mind, a resource that you can use where you can really see what the rates are doing. So that's number one, right? That helps take the emotion out of, well, I saw on bankrate.com or NerdWallet or Google Rates. All these places are just lead aggregators to tell consumers that somewhere magically there's a lower rate for a scenario they don't qualify for. And this is kind of just peace of mind and can help lower the emotional stress of like, oh, well, I saw this right here. I saw this advertisement there. It's like, well, it's an advertisement. And somehow, because clients probably buy, I don't know, a half dozen, a dozen, 2 dozen cars in their life, they know, like consumers know when they see a commercial advertising a new Lexus at $299 a month, they know that that's a lease and there's only one car in the entire country priced at that, and that they've got to bring in $15,000 up front to sign the lease. Like consumers know kind of when they're getting lied to or ripped off in the car world, in the buying an automobile world. They don't get it in the mortgage world. For some reason, they see like the lowest advertised rate on one of these aggregate sites, that is just trying to aggregate leads, and that becomes the gospel to them. So resetting that emotional frame and resetting that expectation of where rates really are. Mortgage News Daily /mortgage-rates, and however you're watching this video, we will have a link to that website. Number two, this is another website, another kind of tool that we can use that is not trying to sell you something. So Freddie Mac is a GSE, government sponsored entity or enterprise. I can never remember whether it's entity or enterprise. Anyway, Freddie Mac is one of the entities that at the top of the food chain buys a bunch of these mortgages, right? So Synergy One, we originate the loan, we underwrite the loan, we fund the loan, we will likely even service the loan, meaning that the consumer will see that like the mortgage statement goes out with Synergy One Mortgage. Scott Grove's your loan officer. So we'll handle the loan soup to nuts. But as far as the debt, the actual $500,000 mortgage note, the cash that was sent to escrow to pay for that house, those debts will frequently get bought by Fannie Mae or Freddie Mac. And Freddie Mac has a great tool on their website. And again, we'll put the link because it's some really long link, but it's just like, hey, what can I afford, right? So if I go to Mortgage News Daily and I put in kind of average rates at the time of this recording, October of 2023, average rates in the mid sevens, and I put in my income and I put in what my other monthly debts are, and I put in kind of just a few assumptions about my finances, it will tell you more or less what you can afford. Now, look, the first thing that should happen if you have a question or if you have a client with a question of what can I afford, introduce them to Scott Groves, right? Because I'll take the time to walk them through what does the math look like? Should they get pre-approved? Even if they're a year out from buying, I'd still love to talk to them to say, hey, here's the things you want to be thinking about a year out, like taking care of your credit card, shoring up your finances, right? Making sure if you have variable income that you start to keep track of what are my bonuses, my commission, am I working overtime, right? So it's like, even if somebody's a year out from buying, again, we're recording this in October 2023, if they're like, oh man, I'm not planning to buy until October 2024, we should still start a conversation with them today so that we can put them on the path and we can make sure that they understand what goes into the kind of Venn diagram, their credit, their income, and their assets, what goes into the Venn diagram of qualifying for a house, and where they might need to make some improvements and where they might need to like kind of start tracking so that they can buy that 400,000, $1.4 million house, $4 million house. Like everybody at every different range of income and home ownership and property values, they all need to be on that path to buy, right? There's something they can improve about their credit, income, or their assets in order to either qualify for more or get a better interest rate. However, if somebody wants just a quick tool of like, hey, I'd really like to just go on and see maybe what I can afford, play with some numbers without getting 500 phone calls from, Redfin or Zillow or somebody who's selling your information. Because what will happen now is if you go to a lot of mortgage calculators online, it will give you some basic information, but it's like, hey, do you want your full breakdown with taxes, insurance, et cetera, et cetera? Once you fill in your information, you're now in some lead aggregator's funnel and they will sell your data, and your client will get hit up by 100 lenders and 20 realtors who buy the data, right? From these online mortgage calculators. So if you just want a very generic tool here at Freddie Mac that you can put in some information and kind of see what you can afford, you just look at affordability by income, or you can tell the system how much of a payment you want to make. But the income tends to be a little bit more makes sense, right? People want to put in their income. Let's say they've got a car payment and a credit card that costs about $900 a month. Let's say they've got about $100,000 down. You can start to play with this and see what you can buy and see what you can afford. And so just another great tool that takes some of the emotion out of it. It definitely takes the consumer out of, filling all their information in online, where then they'll be hit up by every realtor and every lender under the sun. Because again, many of these websites, they sell the data. That's what they're there for. They're an advertising or a marketing company. And so just another tool that you can use, you can go over with a client, you can send to your client. I will tell you, there's an emotional anchor, right? Like right now, if you think about in your mind how much a scoop of ice cream is supposed to cost, right? I know I worked at Rite Aid, Thrifties actually, before it was Rite Aid. So I worked at Thrifties as a teenager, and it was 39 cents for a single scoop, 79 cents for a double scoop, and like 99 cents for a triple scoop of ice cream, right? So in my mind, like some ice cream should cost $1 because that's my emotional anchor to like 2 years of scooping ice cream during high school and saying those numbers over and over and over and over again, right? And during my 2 years, they raised the prices to where it was like 59 cents, 99 cents, and like $1.39 or something for 3 scoops. You remember Thrifties has that weird cone scoop thing. So that's my emotional anchor, right? And I'm sure somewhere in your brain, whether it's like the cost to buy new tires or the cost of a taco at Taco Bell or the cost of a gallon of milk, somewhere in your life, you have an emotional anchor to how much stuff should cost, right? You might understand consciously and subconsciously inflation and things get more expensive, and you know, maybe you realize we've got a little bit more gray hair and we're balding men a little bit more than we'd like to admit. You're like, okay, I'm getting older, things are getting more expensive. But the reality is all of us have this emotional anchor. Like if my grandfather was still alive and I told him that to get a fully loaded F-250 Ford pickup, you're going to spend somewhere between 80 and 100 grand, it would blow his mind, right? Like if there's a God, right? Grandpa Leon's rolling over in his grave right now because like spending more than like $25,000 on a work truck wouldn't even make sense to him, right? So the same thing happens with mortgages. Like there is an emotional anchor. You got to think about it. If we're in October of 2023, nobody just wakes up one day and is like, yep, gonna buy a house. I've got my finances in order. I'm finally making enough money. I've decided to get married, or we're having kids, or we want to have, roots in this community. It's a multi-year, sometimes decade-long process for somebody to come to grips with the idea of being a homeowner, right? I mean, I've got clients in my pre-approval funnel that I follow up with every few months for the last 4 years. Just be like, hey, man, when you're ready, I'm here for you. Hey, I know you talked to this realtor and we got introduced 3 years ago. You never ended up buying. If you're ready, I'm here. If you want to have a conversation about finance, whatever. So you got to think about this. People that are buying in 2024 and beyond, they started thinking about this 3, 4, 5, 6, 7, 8, 10 years ago. And the problem for us as realtors and lenders is that emotional anchor from 2 years, 3 years, 5 years ago on what interest rates should be is somewhere between 2.5% and 5.5%. So I don't want to bore you with the math. I don't want to bore you with a finance lesson, but we have been in a bear market of interest rates, meaning interest rates since about the 1970s have been consistently and slowly dropping, right? So from the 1970s, when like the overnight interest rate and mortgage rates and whatnot were in the teens, we've slowly been dropping. And of course, there's been a year or two here and there where rates will increase slightly. But then if you just look at the trend line of interest rates from the 70s until about 2022, so almost 50 years, closer to 40 years, because like 78, 79, the rates were still really bad. The year of my birth, 1979, rates were still in the teens if you wanted to buy a house. So let's call it for about 42 years, we saw this downward trend where anybody who has bought a house, thought about buying a house, done an online calculator for their entire life, rates have just gotten cheaper, right? I'm now old enough and have 25 years almost in this industry where like some of the people I was refinancing at Washington Mutual in the early 2000s who were super stoked to get a interest rate, under 8%. I refinanced some of them 2 years ago at 2.5, 2.625%, right? So whether you're an existing homeowner or you're somebody that kind of just started this emotional seeding process of like, oh, maybe one day I'll be a homeowner, you for sure have an emotional anchor of what rates should be somewhere between 2.5% and maybe 5.5%, right? Before we saw things start to drop precipitously during COVID, during that convergence of crazy events that made interest rates lower than they ever needed to be. Rates were hovering in the 5-6 range. Consumers were really unhappy when they saw a rate with a 6 in front of it. And as of this recording, October 2023, we've got interest rates, right, in the high 7s to low 8%, depending on your scenario. I've got a client who, investment property, not the greatest of credit, multi-unit property. So all the hits that you could possibly get towards the pricing of the loan, she's either looking at an interest rate of like 8.25% with several points, or going to a non-QM lender, right? Like an outside of the box, not quite hard money, right? We're not talking about a loan shark here, but a non-QM loan, non-qualified mortgage, outside of the box, private hedge funds that are pulling these investments. She's looking at that rate at no points around 10.5%, right? So 8.25, 8.5-ish with some points, or 10, 10.25, 10.5 with no points. If you're A+ perfect, you did everything right, you're putting 25% down, you have excellent credit, you have a great, like you beat the game of finance, right? You're going to get a rate somewhere in the mid to high 7% range as of October of 2023. And I was talking to somebody that fits in this box. They're putting 30% down. They're going to buy a $2 million house. One's a dentist, one's an engineer. Like, they've done all the things right. And they're like, Scott, it's really deflating knowing that because we're buying 2 years later than a bunch of our friends, our cost to carry that debt is, $3,500 more expensive per month just on interest. I mean, that's a tough pill to swallow, right? And so what we have to go back to as realtors and lenders is like, one, affordability, right? I never want to put somebody in a house that they can't afford. Can you afford the payment? If you can afford the payment, if you're okay with the payment, the interest rate is inconsequential. I talked to a client the other day and we went through the whole thing in his purchase scenario, and the payment was around $4,700, and he was okay with that. And that was within his comfort range for what he could afford monthly. His rent's like $3,800. So he was like, $900 more to be an owner instead of a renter. That's why I've been saving the money. That's why I've been staying in this apartment in the west side of LA for 10 years so he could save his down payment. And then as an afterthought, he's like, oh, but by the way, what's the rate on that? I was like, it's probably going to be around 7.5, 7.625. And because of that emotional anchor of where he thinks rates should be, even though he can afford the payment, even though he's comfortable in the price point where we're looking, even though he wants to be a homeowner versus a renter, he recoiled and said, oh man, maybe I should hold off buying. Like, I should hold off shopping for a home because like that's a really high interest rate. I'm like, and I had to like walk him through, hey, I get it. Not only is it a higher interest rate than what we've had the last few years, that emotional anchor of where you think rates should be, that's pretty rough. But if we look at anything other than about the last 10 or 15 years, a rate somewhere between 6 and 10% for long-term debt, that's been about the norm, right? And by the way, none of that matters because you're comfortable with the payment, you're comfortable with the down payment, and you're comfortable with the monthly payment, comfortable with the down payment, and you want to be a homeowner, right? So don't get fixated on the rate unless the rate affects the payment to a point that you can't feel comfortable making your mortgage payment, which of course we never want to do, right? And so these are kind of the emotional anchors we're dealing with and how we have to reframe the math. Now, here's the other thing that's happening is that I feel like the bad guy sometimes, right? I've got a client and I'm just like the no guy, right? So clients originally wanted to get a home with 0 down because the boyfriend is a veteran. He's a veteran, so he can take advantage of a VA loan. He can do 0 down. Unfortunately, his business situation and his newly acquired self-employed income doesn't have a long enough track record to qualify for a home loan. So we can only do the loan in his girlfriend's name. Well, if we only do the loan in his girlfriend's name, she is not a veteran. You can only do a VA loan with married spouses if you're going to use joint income. We can only do the loan in her name with her income. Therefore, they've got to put 5% down, right? Luckily, she makes great money. They can still qualify for a condo in the LA area around 500,000 or so. So they're out there looking. But because they're frustrated with the rates, they're frustrated that they have to put money down instead of using the 0 down VA option. They're frustrated at where the payments are because of the fact that rates are rising. Once a week, I get an email or a phone call from them. Hey, can I use the California Dream Down Payment Assist program? No, unfortunately, that ran out of money 3 weeks after it was launched. Okay, hey, can I use this other grant program? No, unfortunately, there's income limits on that. If you make more than $72,000 a year, you don't qualify. Oh, okay. Hey, can I do this widget over here combined with this thing over here to put this puzzle piece together to get this free $20,000 in community funding? No, unfortunately, to get that, you have to have this income level, and you can only buy in these housing tracts, which are low to moderate income housing tracts in neighborhoods you're not interested in. So it's like, I just feel like the bad guy as the lender, right? This is the reality of like the emotional damage that's happening to lenders, is that as clients are trying to think outside of the box and they're doing their Google searches and they're going to these websites to look up interest rates that are just advertising scenarios that don't exist, right? Like if you ever read the fine print on one of these mortgage online rate quotes, it's like, must put 40% down, must be in Maricopa County, Arizona, must not be self-employed, must pay 2 points. But it's like nobody in my world, I normally service Los Angeles, Las Vegas, and Austin, Texas. Nobody in my world actually qualifies for the rate that's being advertised, because either they're not putting 30% down, or they don't want to pay points, or they're not in the particular county that's priced better, or they are self-employed, or their credit score is not over 800. It's like, there's just always some disqualifying factor. So I kind of have to be the bad guy and give the bad news, which is why it's even more important than ever that us loan officers and realtors work together. We're strategizing. We're having pipeline calls. We're having conversations about what's going on with the client and their finances and what they're thinking and where they're getting frustrated. I can tell you, I've had several realtors save deals for me because they're like, hey, this client's really frustrated that you haven't got back to them on this down payment assist program. I'm like, oh no, I got back to them. It just wasn't the answer that they wanted to hear. They're not eligible for that down payment assist program. Let me give them a call and like walk them through that again, right? Conversely, I've saved a lot of deals for realtors by calling the realtor and being like, hey man, the client's getting really frustrated. They don't understand the dynamics of, yes, we're on our second, third, fourth offer. There's just so few properties available on the market that it's going to take multiple offers before they get one accepted, because everybody and their brother is bidding on the same 3 available great homes in the neighborhood, right? There's lack of inventory because so much of the inventory is locked up at interest rates under 4%. And those people will never sell, right? I have a property that I should sell. It's about a $650,000 4-bedroom, 3-bath kind of starter home. I should have sold that when I moved to my new house. But the reality is we have a 3% interest rate on that. It made more sense to rent it out than sell it. Like we're never going to sell that house, right? That's one unit of housing that's not coming back to the market for these first-time buyers. Now replicate that hundreds of thousands and millions of times across the market. We just have limited inventory. This is the conversation that I'm able to have with the client, or I can tip off the realtor to have with the client so that you don't lose momentum and you don't lose the client. So this is kind of how we have to deal with the fragile emotional state of buyers, right? Now, here's one tool that we are going to talk about. And you've probably heard this discussed, but maybe you haven't actually seen what the math actually looks like. And it's this idea of a 2-1 buy down. And a 2-1 buy down is just a really fancy way to say you're having the seller prepay interest. And I'm going to show you the math of how this works. So a 2-1 buy down means that for the first year, the interest rate is 2% lower, 2. For the second year, the interest rate is 1% lower. And then on year 3, it goes to the fully amortized payment, and then you make that payment for 28 more years, right? Now, there may be an opportunity to refinance in the future. There should be an opportunity to refinance in the future because all markets are cyclical. Interest rates go up, interest rates go down. But if you remember from my conversation earlier, we were in basically a 45-year cycle of downward rates, right? That's kind of where we were from the late 70s until about 2021, 2022, where rates were just continuously dropping. And then we saw them start to go up in 2022. So when loan officers are out there telling realtors or clients, oh yeah, we'll just refinance in 6 months, it makes me cringe. There was this big, conversation or social media tag going around about a year ago, like, oh, marry the house and date the rate, right? Just date the rate because you'll be able to refinance in 6 months. Well, we don't know that to be true, right? We don't know that to be true because sometimes these interest rate cycles can take years or even decades to see these big shifts up and down. Now, I will tell you, I have a piece of software where I keep track of my clients so that if there is a momentary dip or a short-term dip in interest rates, which again, a normal 5, 10, 20, 40-year trend line, we'll see a lot of ups and downs, a lot of dips. If we can catch one of those dips, I have a piece of software, a tracking system, a CRM that lets me know, hey, this client originally got their mortgage at 7.37%. At 6.5 might make sense to refinance if we can kind of catch that falling knife when there are these ups and downs, right? But a tool to kind of soften the blow is the 2-1 buy down, meaning that the interest rate is lower by 2% in the first year, lower by 1% in the second year, and then goes to the fully amortized 30-year fixed rate from years 28 and on. And the reason this can be helpful is there's a lot of expenses when you buy a home, right? That first year you get into a home, you have movers, you're painting the place, you're buying all the stuff at Target, IKEA, or Amazon, or Crate and Barrel, or whatever that you need to like put the house together. And so sometimes getting a 2-1 buy down can be enough to make the client feel comfortable, like, all right, at least in my first couple of years of ownership, the payment is lower, right? And in a couple of years, I'll be making more money. I'll have less overhead. I'll feel in a better position. Maybe I do think after a serious conversation with my loan officer, that's me, Scott Groves, maybe there will be an opportunity to refinance into a lower rate in the next couple of years, but let's talk through that. And then I show them this spreadsheet, right? So this is on $1 million purchase. If you notice, all of the data on this is the same, other than what we show here as, let me just annotate this here. Maybe it won't let me annotate. How do I annotate? Highlight. Okay. So here we go. We're doing just like $1 million purchase, right? And we are showing 20% down in all scenarios. But if you notice down here, we're showing this interest rate of 7.875. So this is a consumer that, bad luck, they're buying in October of 2023, and maybe their credit wasn't excellent. So they're getting 7.875, right? Well, in a 2-1 buy down, the first year of homeownership, they can have a rate of 5.875 because the rate is 2% lower. In the second year of homeownership, they can have a rate of 6.875. And then if they don't have an opportunity to refinance, or they don't sell the house, or they don't pay down the mortgage or whatever, their fully amortized rate will go to 7.875 in 2 years. But look at the difference in payments here on $1 million house, right? It's the difference between $4,700 a month in the first year, $5,200 a month in the second year, and then $5,800 a month in the fully amortized payment, which will happen 2 years from now. So in that first year of ownership, we're like, hey, we can give you a slightly lower payment, or a significantly lower payment that's $1,100 cheaper per month. Now, if you notice down here, the taxes and insurance stay the same, and they still need to know what their full payment is. And I'm having the conversation with the client, hey, we think there's going to be an opportunity to refinance, but I don't know. Are you still comfortable here with this $7,000 payment 2 years from now? If not, it's a non-starter. If you are, then let's talk about how you execute on the 2-1 buy down. And the 2-1 buy down is simply a credit we get from the seller. So let's say, for example, in this scenario, the 2-1 buy down ends up costing about $2,000 per $100,000 borrowed. $2,000 per $100,000 borrowed, right? And so what I would tell this client is like, all right, you're going to buy this house for $1 million. You're putting 20% down. You're getting an $800,000 loan. $2,000 per $800,000. That's about $16,000. Now, if you're the client and you're just paying for this, it's like, well, I can either pay it out of my pocket now, or I could just amortize it over the interest of the loan over the next 2 years. That wouldn't make sense, right? So they don't, meaning Fannie Mae, Freddie Mac, the lenders, we as lenders don't allow the client or the realtor to pay for a 2-1 buy down, because that's money that they could have just amortized over the life of the loan instead of paying up front. We do allow the seller to incentivize, we do allow the seller to incentivize people to buy their house by the seller paying for the 2-1 buy down. So let's say, for example, on this, we wanted to tell the client, hey, your interest rate is going to be 2% lower for the first year, 1% lower for the second year, then you have to be comfortable with the full payment. But the seller is willing to pay for a 2-1 buy down so that you can get that lower interest rate. So one of two things would happen. Either if the seller is motivated to sell this $1 million property to our buyer with an $800,000 loan, the seller could agree, hey, here's a $1 million price point. We're going to credit the buyer $20,000 up front to pay for this property for the 2-1 buy down, and we're going to net $980,000. The seller could agree to that. Or if it's a competitive situation where you know you have to pay $1 million for this property, the buyer could offer $1,020,000, right? So that the seller can still net the same $1 million, but the buyer could offer $1,020,000 with a $20,000 credit back to them to pay for the 2-1 buy down. So what ends up happening is incrementally, the monthly payment goes up about $100 a month because the purchase price is going from $1 million to $1,020,000. But in that first year or two, they're saving, $1,000, $1,100 in the first year in this hypothetical situation, and they're saving about $600 in the second year in this hypothetical situation because they overpaid for the house by $20,000, but then got this as a credit back to them to pay for the 2-1 buy down. So this is why the realtor and the lender needs to be in conversation, in relationship, and checking in more frequently than ever. Because with every offer, we might want to have that conversation, me, you, the realtor, and the client. Hey, this property's been on the market for 60 days. We don't think we need to swing for the fences. Let's offer X and then ask for a credit of Y so that they can net, Z price, and we can get this 2-1 buy down paid so that the house is a little bit more affordable the next couple of years. Or we might have the conversation, hey, this property, whether it's at $500,000 in Vegas or $1.5 million in Los Angeles, this property is a really hot commodity. It photographed well. There was 70 people at the open house. We're actually going to have to offer above the list price. And whatever we were going to offer above the list price, let's offer an extra $10, $15, $20, $25,000 than we thought we were going to, but ask for that back to us in the form of a credit so we can pay for this 2-1 buy down. And, buyers, and this is where the emotion comes in, buyers right now are just looking for a win. They're like, hey, they're not saying this out loud consciously, but this is what they're thinking subconsciously. Hey, I had in my mind that I was going to buy this property and the rate was going to be 3%, 4%, 5%. Now you're telling me I'm getting 7.5%. And the buyer's thinking, okay, well, at least if rates go up and it gets more expensive to buy a house, the prices have to come down, right? Well, no, unfortunately, because there's so little inventory out there and so much property is locked up at that 3% interest rate, like the house I told you about that I own, property values aren't going down because there's not enough supply to force the prices down. So no, you still have to pay full price. And in a lot of markets, you still have to pay over the list price in order to secure a property. Okay, cool. Well, Scott, let's look at my full monthly payment. Oh, hey, bad news. By the way, homeowners insurance is also going up. So it's like buyers are just getting emotionally beaten down. And then we as lenders and realtors are like, oh, I wonder why more people don't want to make an offer. So it's because they're emotionally beat down, right? The buyers need to get a win. So structuring this 2-1 buy down, even if it's like the same net dollars to the seller, you have to offer a little bit more to facilitate the buy down. Even if that's the case, it gives the buyer a win, right? It just gives them an emotional win of like, hey, I got a lower cost of ownership for the first couple of years. For a lot of buyers, just getting a win, just like getting something in the win column, will help them get over the hump of making offers. And I think this can be really powerful. So as always, Scott Groves here at Synergy One. My email forever and always for the rest of my life will be scott@scottgrovesteam.com. Cell phone number 818-679-5188, 818-679-5188. Mortgage News Daily, right, as a resource for rates. mortgagenewsdaily.com as a resource for rates. We'll put in the link here for the Freddie Mac home buying calculator to kind of take the motion out of it and try not to get clients stuck in all these lead funnels of, you know, people buying their data. And then the 2-1 buy down, and hey, just more conversations between me, the lender, and you, the realtor. And we'll talk soon. Love you lots. Bye.